Hello everyone, this is Bella. Welcome to my new teaching video on technical analysis. Welcome to my new teaching video on technology analysis. In previous classes, we've covered most of the basic concepts, underlying logic, and technical tools needed to make a deal. If you haven't seen it yet, you might want to look at my previous videos, and if you don't have a good grasp of the basics, it might be difficult to understand what I'm sharing. Future videos will focus on a few bits and pieces of knowledge and answer some of the audience's valuable questions about technical analysis and trading. Today, we're going to focus on two issues. One is how we look for key price levels as we read the charts, or what we call key support resistance. The second is how prices behave when they move to critical levels. Solving these problems will be of great help to our trading entry and market management. Let's start with the first part: why we find key price levels and plot them on the chart. It's very simple. These are all potential reversal zones for price movements. They can provide us with good trading opportunities, and they can also provide us with the basis to reduce or liquidate our positions when we are in a position. More importantly, if the price successfully breaks through these key levels, it is likely that the market has changed. We need to adjust our trading views and keep pace with the market. Just to remind you that all of the support resistance that we're talking about is not a certain price, but a certain price area. How to find the key price level? Every inflection point in the price movement in the chart creates some support resistance to subsequent price movements and acts as a potential reversal area. But we can't focus on so many price levels at the same time. Just drawing them out and clutching up the chart is not good for our trading. We only need to focus on the important set of band points. The first is a familiar trend movement in which the last pullback in the band is worth focusing on. In a healthy trend, the high and low of the band should show a healthy trend movement. For example, in a bullish trend, the high should gradually move up and the low should gradually move up. The short trend should in turn see the low lower and the high lower if there is a contrarian breakout, making new lows, in a bull trend making new highs. In a bear trend, these are all signs of an unhealthy trend that could be subject to complex pullbacks or even trend reversals. So in a trend movement, the major players on the trend side must defend the last pullback as much as possible from being breached against the trend. The greatest value for us traders to watch this level is to determine if the trend structure is broken before this level is breached. We should not assume that the trend has reversed, and we should not be too confident in the contrarian trade, and once this level has been successfully broken, we should not be able to participate in the trend direction until we find a strong entry pattern and confirmation signal. And just to emphasize, one of the things that we've been talking about over and over again in this course is that a trend reversal is always a low probability event, and even if the point is successfully breached, it is likely to be a complex adjustment of the trend rather than a trend reversal. And it's important to remember that many of our novice friends died from bottom hunting and topping out in a reversal pattern. Again, how to find this point? Each trader may define the last pullback band a little differently. For me, it is only when there is a new trend pull that I will mark the last pullback band. It's easy to see if you look at the chart and you see this bull trend and this rally makes a new high and it breaks through this point, and I'm going to label the first point that the previous pullback formed, and then this rally makes a new high and I'm going to label the new band point right here. And you can see here that I didn't mark this little band low because the subsequent little rally didn't break the previous high, and the subsequent down breakout could be classified as a pullback rather than a contrarian breakout. Moving on, this rally is supposed to be a false break of a channel line that I haven't drawn here, and then a strong short break that not only breaks the previous band low, but also breaks the previously marked support level, directly reverses the bullish trend rather than creating a complex pullback. Our main concern is that the first leg down after the pullback of these levels made a new low, and we marked this as a simple correction and continued to break out and make a new low. We're going to mark a new level, and then finally here we're going to mark a new level after the correction, and we're going to mark a new level, and this is a very clear technique that you probably learned when you got started, but I don't want to talk about it. When I mark a new horizontal bit, I usually delete everything I've drawn before to keep it simple. Let's also think about the question of whether we can look for opportunities to participate in the trend movement if the price retreats to the previous band correction point. I used to like to look for the entry signal at this level, but recently I have discussed with other trading friends and reviewed a lot of cases. The conclusion is that the trading opportunities here aren't really that great. I'm just going to go through the logic for those of you who are interested in finding your own case review, study summary. First, at the point of the previous trend pullback band, there must be a lot of pressure to get in, and that's the logic that I like to use to find an entry signal here. And if you've read enough trading books and you've studied institutional thinking, you know that strong players on the trend side are going to place a lot of entry orders in these positions. Contrarian players tend to use these positions as their closing targets, and these are all factors that are positive for the trend side. But if you look at it another way, if it is a healthy trend movement, then the price should not have retreated so far, and the fact that it has retreated to the previous correction point indicates that the market is no longer a clear trend movement. Then the low probability continues to break the high probability in the trend direction, and it goes into a complex consolidation or trend reversal. The reason I like to look for an entry signal here is because I expect that the market will probably start to sort itself out at this point. At this level, I would be ready to walk out of the door if I came in and found out that the price was doing a weak bounce. So I felt that the entry pattern was good because I was doing order management, not because the pattern itself had a strong logic behind it. Just to summarize, the last pullback in the trend movement is the level that we need to focus on. Until it is successfully broken, we can't assume that the trend has been reversed. We can't have much confidence in the contrarian trade. If it is successfully broken through, it means that the trend structure is destroyed and may enter into complex consolidation or trend reversal. We pay attention to this level mainly to judge whether the trend is healthy. If the trading technology is not up to standard, it is not recommended to use it as a reference for entry. One thing to note is that we tend to look at this level when we're in a healthy trend, and if the market is not trending or if it's trending in a complicated way, it's probably not going to be that important, so we don't have to get too obsessed with this on a case-by-case basis. The second and most familiar, well-tested level is one that is worth paying attention to. Traders who are doing either a level check or a level break like to see this state of the market. The logic is simple. When a level is strongly verified, there is a strong entry into the price area. Other participants in the market will recognize this pattern and follow it. The level's resistance will be reinforced. Traders who like to test the level will focus on these price areas, but what happens when the level is breached? The illustration in the chart shows that since this support level has been tested over and over again, it naturally attracts a lot of participants to enter the price area and go long because there is a lot of money entering the price area. So if this support level is broken strongly, these participants will cut their losses and leave the market, and their large order volume will be the driving force for the subsequent market decline. Smart participants on the sidelines will also pick up on the message that the market has changed, and they will actively participate in short selling to accelerate the decline. So traders who like to make breakthroughs will also focus on the price area where many proven levels are successfully breached, which often leads to rapid rallies. And then there's the multiple validation level of the no-group swap like this, and that's the price area that needs to be looked at, and we'll talk more about the logic of the architectural movement of no-group swap in the second part of this video. Here we can also see that the support resistance is a price area rather than a certain point, and sometimes the price validates a support area over and over again, but each time it's a very uneven band with the long shadow, and it's hard to find the exact level. It is best to avoid trading in such market conditions for participants who like to make a breakout. It is also not good for traders who like to do support verification to enter, because he is a long shadow verification after entering the stop loss is too far to sacrifice the profit and loss ratio. Unless you are a trader who likes to use a wall entry, you should avoid this type of trading. To summarize, the level that has been proven over and over again is something that we need to focus on, and it provides us with very good potential trading opportunities for both validation and breakout. The third one is also very simple, and we need to focus on the support resistance on the big cycle chart, and let's say that this 30-minute chart on the left is the chart where we trade, because it's all different. The reason for this is that we have entered at a high level and the margins are running comfortably on the short order. While we are in the position, we need to watch the band support on the right of the 2-hour cycle chart. The support on the 2-hour chart has the potential to reverse the short trend on our 30-minute chart. We can take profits on our small cycle orders, or at least take half of the profits out. If there is a strong reversal pattern in the small cycle near the level of the big cycle, it will provide us with good trading opportunities. To summarize, we focus on the support resistance on the larger cycle chart, mainly to provide the basis for a profit exit on the smaller cycle and sometimes a good trade opportunity. Finally, we also need to focus on the several points promoted by each trend to observe the amplitude and intensity of the subsequent trend breakthrough to judge the strength of the trend energy change. It is better to look at the chart. We see that there is a strong short push at the beginning and then a small rebound to form a trend pull, and then the trend continues to fall below the former band point, but the breakthrough range is small and the K-line shape is very weak. This is characteristic of the weak trend. And then we have a couple of successive pullbacks where the energy is weak, and then we have a deep retracement, and this deep retracement is followed by a continuation of the trend, and we look at this wave pushing it through the extreme of the previous trend very strongly and by a very large margin, which is characteristic of strong trend energy, and then we test the breakout point back and the drop continues to drive the decline. It is still a strong breakthrough of the previous trend extreme value, or a feature of strong trend energy. This is what airdrop hopes to see after the breakthrough of the previous trend extreme value. If the test happens to this level and there is a verification signal, it can also provide us with a good trend entry opportunity. To summarize, we look at what is driving each trend to determine the strength of the trend so that we can make decisions. In some cases, breaking the pre-test band can provide us with good trading opportunities. So in general, when we're trading, we're just going to have a good handle on these levels, and we're going to draw at most 2 or 3 horizontal lines on the chart, and we're just going to focus on the price areas that are most important to the current state of the market, and we're going to keep the chart simple, and we're going to focus on the price movement itself. Finding key support resistance is a very easy task. You can quickly improve your ability to find key price areas by redrawing dozens of charts and drawing hundreds of horizontal lines. But it's not that easy to make money off of this. If you just go long on support and short on resistance, there would be no poor people in the world. Being able to recognize price movements around important levels and make good decisions is a very important ability for traders. So that's the premise that we're going to do order management, and we're going to move on to the second part of today's video about what happens when prices move to key levels, and I'm going to share with you some of the most common price patterns that support resistance areas, but it's a very complex and large topic. Some price performance that I can't categorize and explain requires you to feel and summarize in the actual transaction and find ways to deal with it. One more thing that we're going to talk about is that these price behaviors are not only acting on key horizontal support resistance, but also in various other types of support resistance areas such as trend lines, channels, moving averages, and so on, where there is a support resistance effect that we're going to be talking about. So let's look at the first graph, and this is a very good example of two kinds of price behavior that we're going to talk about at the same time, and this is a standard trading band, and the upper and lower boundaries are very reliable and have been tested many times, and we can look for potential trading opportunities around these two levels. If we look up here, we can classify it as a rush breakout, and it doesn't have a breakout pattern near the water level, and it doesn't have any pause after the breakout, and that's a price move that I'm not going to participate in. In the trading range video, I shared the logic of why not participate in the breakaway market. If you are not clear, you can read it again, and I won't go into it again. So if the price goes through a critical level in a hurry, we don't have to think about order management because we're not going to trade at all. If you look down here, it's also a strong break above the level first, but the price immediately comes back within the range, giving a false break validation that you can go long, and then after you go in, the market is going to move up, and if you have this kind of strong validation of the level, and we don't have to worry about order management because the price goes straight to the bottom and there's very little return. We all trade in the hope that this will happen, but the market doesn't make us that comfortable most of the time. There is nothing to say about either of these price performances. Breakouts and strong verification are easy to deal with. If we look at this diagram and we're going to go short in the resistance area above, the first arrow K line and the K line to the left can be interpreted as a double K line reversal signal. It's not quite standard, but it's a successful test of resistance. We came in short here in anticipation of a decline in price, but we found that after we came in there were only 3 K lines that met our expectations. We fell a short distance and then we started to see a series of large overlapping non-trend K lines. This shows that the price at the level of only a weak rebound. Then look at the second arrow mark. This K line is a strong bullish trend K line, which shows that the market is biased towards the side that expects the level will be broken. If it is to do K analysis, traders see this K line after the close of the market will be flat out single leave to C, and just strong verification of the example is not the same. This level is a weak rebound strong breakout price performance, in other words, a breakout correction or breakout pattern. Sometimes this happens in the space of a few K lines and doesn't give traders much time to react. Let's look at the K line marked by the third arrow, which is a nice single K line reversal and has tested the previous small high. We can short this K line after the close in anticipation of a small double top in the resistance area. This is a good second entry signal for the first arrow, but the next K line has a very long down line, which is a weak down performance. The next K line is our mark number 4 K line. He closes a very long down line and closes near the high K line. After just 2 K lines, the market basically negates our trading expectations. If a K by K trader breaks on the 4th K line, he will break the short order and eat a small bamboo shoot. It is logical that more aggressive traders would even participate in the long position after the break on the 4K line, as this is a potential pattern for a weak rally strong breakout. But if you come in at line 3 and you short, it doesn't matter if you don't do order management because it's a very short line. It doesn't matter if you have a lot of computing space and it's a very profitable trade. It is recommended that we look for such a weak rebound strong breakthrough case. Some will rebound 3K lines, some will rebound 5K lines. The key is that we have to read the strength of the price movement energy change. Just as a quick review, if there's a lot of overlap in the K line with the long shadow, that's a sign of weakness. If there's very little overlap in the K line and there's a lot of trend in the K line and there's very little counter trend in the K line and the shadow line is very few and very short, that's a sign of strength. In general, this level of price performance management requires a certain amount of trading experience. If you feel that you are really confused, there are some simple ways to do this, such as simply giving up order management and letting the price hit your profit and loss level. This is also not a problem because we have positive mathematical expectations in the entrance itself is advantageous, or there is no problem in designing a mechanized order management strategy, such as closing the position directly if 5K wires do not meet the expectations after the entrance, and setting the break-even price directly after leaving the unit price. Let's go to the next case, and let's say we're long at this level, but the K line here is a mess, and I'm definitely not going to be long. Let's say we're long, and then we look at the subsequent price performance. This rally up, we have a strong long trend K line, which is a strong performance, but then we have a K line with a long upward lead. Another inner cross followed by a lower break of the short trend K line. Looks like this rally may not meet our strict definition of a strong move, but the relationship between strength and weakness is comparative, and we continue to watch for subsequent declines. Although this decline has seen a succession of short entities, the K line overlaps significantly, and with many shadows it is clear that the decline is weak compared to the previous rally. And then again, there is a strong bull level to gain support for rapid gains. We classify this performance as a strong bounce weak test, and in actual trading, there are a lot of situations that are more complicated than this chart case, and the biggest difficulty with the strong bounce weak test pattern is that we don't know in advance where the weak test is going to go, and it can be like our case. The test move, it creates a high rise that is not much of a threat to our holdings and is the price performance we would like to see, but this weak test, it can also move near the former low and a strong rebound to make a double bottom. Our position is at risk of being knocked out of the stop loss, and even this weak test, it could make a false break to the front lower to knock out our stop loss and then go up strongly, which would make our position very painful. And to take it to the extreme, his weak test as he goes along suddenly speeds up and becomes strong, which is rare, but it's also consistent with the logic of price movements. To go back to the usual trader cliché that the market can't be predicted, we just have to play it by the seat of our hat, and when a rally occurs, the price usually hits a number one technical target and we have the option to close out half of our position and keep our capital break even. If the strength of the price continues, we can make a subsequent profit, and if the subsequent weak test turns out to be a failure, we won't lose money. If the weak test breaks even and signals a strong rally, then it's a second entry opportunity, and we can go back in and trade without losing anything. And of course, you don't have to do any order management because there's been a strong rally that confirms our entry, and it's logical to hold the position and watch the price go to the end of the gain. But if a trade that's already had a big gain turns back into a stop loss, that's very uncomfortable for most people. If you look at this graph again, what happens when you're trading is that the price has made a small division near the horizontal level. If you look at the details, the K line to the left of the arrow verifies this false breakout at the horizontal level in the form of a very long down lead, and then you look at the K line at the arrow, which is a good bull strong verification that it has a large long entity with a long down lead and a short up lead, which is not bad. But after that, there are a lot of K lines that overlap a lot with this K line, and we know that this is a mini trading band. In the trading band videos, we talked about this price pause when we break out, and we don't know if it's a break back or a break failure, so we're just thinking about what to do instead of trying to predict what's going to happen next. There's no right answer to order management at this price, just do what you like. If you just want to trade with a high win rate, then you just close your position and get out because the market is in a state of uncertainty. If you don't want to do order management, you have no problem holding your position and waiting for the price to clearly break, even though the winning rate will decrease, but when the price breaks in the direction you expect, it will greatly strengthen your entry logic. I've been known to come in when a breakout fails, and I tend to think it's a fake breakout, and I was talking to a trader who specializes in breakout recently, and he sees both the breakout break and the post-breakout break as a breakout pullback. Again, he and I are completely opposed to each other, and there should be only one person who can really make a profit, but actually neither of us is wrong. I expect it to be a breakout failure, but when it turns into a breakout correction, I'm going to eat my hat and get out. He thinks it's a breakout correction, but he's going to get out as soon as the market reverses. He and I are both stable traders in the long run, so a lot of times it's not so much the analysis that makes you rich, it's the decision making and the execution. Finally, let's look at the breakout retracement of the horizontal level. Why prices often retracement after breaking support resistance is difficult to explain on a case-by-case basis. Today we will focus on why breakout retracements provide us with good trading opportunities. When this level was still a support level, there were a lot of participants who were long it. And when it was broken, some of the traders who were long would just liquidate and run, and some of the participants, they decided to see maybe they could find another reason to be long, maybe they just didn't want to cut their losses. And then when the price did fall sharply below that level, all the participants realized that this was a real breakout. And the traders who were long earlier and didn't get out of the market were so caught up in it that they prayed that God would give them the opportunity to get out of the market at least a little bit less. If you get lucky and there's a rally, it could be from the liquidation of earlier shorts, or it could be from other strong traders finding some reason to go long. As the price nears the support level that was previously broken, what the trapped traders do is very simple. They thank heaven for the opportunity to run for their lives while they unwind their long orders. Their departure creates new selling forces, and the smart trader who is on the sidelines will pick up on this information and will participate in the short position. The main bears that drove the price down earlier also see this level as a reasonable position to add. These bearish forces add up and they create a breakout retracement swap. Important note that the logic above is valid only when the breakout retracement shows a validation signal. If the price first goes down strongly and then goes up strongly, it means that the overall market pattern is not in line with our expectations. It may be because there are some mistakes in the interpretation of the market state, or it may just be that the breakthrough energy is not as strong as we think. Therefore, I will never place an order in advance when doing the breakthrough back test. Sometimes a breakout retracement can be completed within a few K lines. If you are good at identifying micro price behavior or can find these entry patterns on a small cycle chart, then you can catch a lot of good trading opportunities. This kind of micro initial retracement is relatively common. To sum up, these are the common price performance in the support resistance area. There are some difficult to classify that I did not talk about, with fewer picture cases, but I have explained the logic behind it. I suggest that you combine today's learning content with the K-line playback function in the actual chart to review and feel. After all, reading a chart that's already gone is a very different experience than reading an analysis on a live chart. There are 3 questions that we always have to ask when trading. What is the state of the market? Now, who is strong and who is weak? What should I do? I believe that after a period of practice, everyone's trading level will be significantly improved. Alright, that's all for today. Thank you for watching. Please consider like, comment and subscribe. Also, don't forget to follow us so you watch the following updates as fast as the video upload. Bye.